Rosenberg Research, and he's our first guest this morning. David, thanks a lot for joining us. You've published a lot recently on market uncertainty. There are several gauges of uncertainty that you track that show it at highs. How much of this is coming from the White House and the anticipation of trade tariffs, among other policies from Donald Trump?
All right. Well, thanks for having me on the interview. Most of the uncertainty measures that we're paying attention to are anywhere between 2 and 4 standard deviations above historical norms. I mean, Paul, we always live in an uncertain world, but this is an uncertain world on steroids. And I would say that it's probably 100% related to the chaotic trade policy threats coming out of the White House. I would pin it almost all on that. I'd say layered on top of that, of course, is ongoing budget uncertainty and the extent to which the House and the Senate can get their act together on a budget bill. So I think that you have really 2 things at play here. You have tremendous trade and tariff uncertainty that's having an impact globally, and that includes the United States. And you've got elevated fiscal uncertainty bumping against that at the same time. How
realistic do you think are fears of a global trade war, similar to what we saw in the 1930s?
Well, the global trade war in the 1930s was well beyond even what we're seeing right now, even if Trump goes ahead with the reciprocal tariffs that he's talking about. But it's going to be a lot more significant than the tariff increases that Trump put on in his first term, when it was, selected across different industries, steel and washing machines and solar panels. And of course, a lot of that trade friction in Trump 1.0 was really just different chapters being written on the U.S.-Chinese economic war that is obviously ongoing. So I don't know if I would go so far as to compare it to the 1930s. I think that's a little extreme. But suffice it to say, this is magnitudes bigger than what we saw in 2018, 2019. Remember, in 2018, Americans benefited from $1 trillion tax cut. That's not coming this time around. You're not going to have that fiscal cushion in the United States. So I think that insofar as Trump carries through with his pledges, it's going to be enough. It's going to be enough to cause a global recession. The 1930s was a depression. I don't think I'd go that far, but it would definitely create the conditions for a global economic downturn that I'm not so sure the White House is taking seriously.
And yet the S&P 500, the key measure of the U.S. stock market, rose the day after the U.S. election, the day after Donald Trump was elected to the White House, and has drifted higher since then, now trading, as we can see on our screen here, at 6,100 points and change. You think the stock market is overvalued, correct?
Well, I've thought that for a while. I mean, you have an equity risk premium in the United States at 0, some measures even below 0. So, if you believe in the longevity and the veracity of the U.S. bull market, then you have to be of the view when the ERP is 0 that the equity market has miraculously become as riskless an asset class as Treasury bills. So that's what the market's telling you right now. So no, I'm not there. In response to your first part, the reality is that the stock market took an initial huge jump off Trump's sweep back in the first week of November. We had a surge above 6,000, and then we've just leveled off. So I guess a bull would say over the course of the past 3 or 4 months that the market's holding on toward near these record highs. And then somebody else might say, okay, but we've not made any headway in the past 4 months. So is that representing a classic topping formation in the S&P 500? And time will tell, but beauty's in the eye of the beholder. But suffice it to say that if you're buying any equity market at a 0 ERP, your assumption ipso facto has to be that equities all of a sudden have become a zero beta riskless asset class. And frankly, I don't believe that's what I would define as being rational. But we've seen the markets behave this way in the past. It doesn't usually end well. But in the process, everybody seems to enjoy it. But that's the reality. Equity risk premium at zero to me is danger zone.
What about earnings coming into coming into the fourth quarter? It was common to hear people say that valuations are high, PE multiples are high on S&P 500 stocks. The aggregate PE is high, but if earnings come through in Q4 and Q1 to support those earnings, the market may have legs. What do you think of recent earnings performance?
Well, it's not uncommon that you go into the quarter with the estimates downbeat. The market almost always beats those estimates. And so you're quite right that we're looking at double-digit growth, call it 12% growth for Q4 earnings year over year, but the market's up well over 20%. So yes, it's true that earnings have been doing fine, but you've got the market has been doubling the performance of earnings growth, right? So hence the run up in the forward multiple to 22, 23 times. So that's still an issue. So you're quite right, about the earnings quotes coming in. However, if I had to complete your thought process, I'd say, well, it's not as if the price action in the stock market has been going up tit for tat with the earnings growth. It's doubled what earnings have delivered. And we'll see what happens, in the next year. What I've been detecting is this. The analyst earnings revision momentum peaked in May, and it's rolled over. We're talking about the estimates for 2025. That revision momentum, which was positive, peaked in May. It's rolled over, and yet the market's still up 20% since that time. So you're sort of scratching your head. It's why I titled one of my recent reports, it was called No Market for Old Fundamentalists. It's really a classic price momentum, sentiment-driven stock market that we have in our hands. On top of that, what else are we seeing is that even though, as you said, earnings are coming in either above expected or certainly double-digit growth year on year, 100% true, corporate guidance for the coming quarter, coming year has been decisively negative. So the question is, do you want to trade off of what's already in the rearview mirror? Or if corporate CEOs, by the way, who have been selling their own stock, when you look at the insider buying to selling ratio, that's made a very big move in the past several months, and not in a beneficial way. But the corporate guidance, and we haven't even seen the tariffs hit yet. Right now, they're just threats creating all this uncertainty. But the corporate guidance itself, forward-looking, has rolled over in a meaningful way over the course of the past couple of months.
Okay, let's finish with the state of the U.S. economy and what you see the Fed doing in 2025. The market, as you know, is now pricing in only one rate cut, and that coming right at the end of the year in mid-December. So you see the Fed acting and cutting more aggressively than that.
Most likely, it's really about a matter of timing. I can fully well understand why the Fed wants to stand pat right now, because it needs to see clarity on the policy front, which we'll see. And if we get the tariffs, what the Fed is going to want to see is the extent to which that's feeding into wages. And if it does, then they're not cutting rates. I think the economy is weaker than commonly perceived. I think people are going to be surprised that first quarter real GDP could actually be completely flat. The Atlanta Fed's close to 3% right now for first quarter growth. I think we're going to see more fiscal tightness than fiscal looseness for this year. I don't think that's really baked in. The extent to which the spending cuts are going to have a really big impact on aggregate demand. And I don't think that Trump is going to be able to get all of his tax cuts through. At best, the 2017 tax relief won't sunset at the end of the year, but that just leaves us with the status quo. And then, as we saw in 2019, Paul, with all this uncertainty, and everybody right now is modeling uncertainty. I just saw a great piece by the Boston Fed on modeling uncertainty on GDP growth. And you saw this come through in 2019, which was getting towards the later stages of Trump 1.0 tariff increases. And of course, that a lot of that was the trade war with China. You had a recession in the production sector in the United States and in capital spending in the second half of that year. We were already heading into a recession before COVID. People don't tend to realize that, and that's why the Fed cut rates unexpectedly 3 times in the last few months of 2019. So I think that from my lens, we're going to get, if we get the tariffs, there's an initial price shock, lasts a few months. The Fed will not be doing anything in that environment because there will be inflation in the data for 3 or 4 months' time. But once I think in the second half of the year, once it becomes apparent that the impact on aggregate demand is going to be so far greater than the initial price shock, that the Fed will start cutting rates. So it's really a matter of timing it. I think the second half of the year, and of course the Fed will be data dependent, but I think the data will lead them in a direction of cutting rates more than what's priced in. I think that's almost a layup. You know, wasn't that long ago that the market was pricing in like the Fed cutting rates each meeting this year, and now we swung the pendulum to that there's just one cut and it's towards the end of the year. I think the truth will lie somewhere in between. I can understand right now, given all the policy uncertainty, that the Fed is deciding to stay on the sidelines and is verbalizing that to the market. But we've seen Powell pivot before. And my theme in the second half of the year is that they'll be pivoting in the opposite direction. And I think that those rate cuts will be coming and more aggressive than what's priced in. Then again, one cut priced in, to me, that's not a heroic forecast unless you're in the big inflation camp that thinks the Fed's going to have to raise rates.
We will leave it there. David Rosenberg, thanks for the insight. He's founder and president of Rosenberg